Welcome back to Decoding Finance. If you're over 60 or getting close, there's something happening in retirement that almost nobody explains clearly. Most people spend decades working, saving, contributing to retirement accounts, and following every financial rule they're told to follow. Then retirement arrives, and suddenly a series of tax rules begin affecting their income, savings, Social Security, and even healthcare costs. The surprising part? Many retirees don't realize what's happening until years later. Today, I'm going to walk you through 5 retirement tax traps that can quietly reduce your retirement income, why they affect so many middle-class retirees, and most importantly, what you can do to plan ahead. And stay until the end, because the 5th trap may be the most expensive of all, not because of a tax you pay, but because of an opportunity many retirees never realized they had. Before we begin, a quick reminder: I'm not a CPA, attorney, or financial advisor. This video is for educational purposes only and is based on current tax rules and publicly available information. Always consult a qualified professional regarding your specific situation. Now let's get started. One of the biggest surprises in retirement is discovering that Social Security benefits are not always tax-free. Many retirees assume that because they contributed to Social Security throughout their working years, the benefits they receive later will arrive without additional taxes. But depending on your income, a portion of your Social Security benefits can become taxable. In some cases, up to 85% of your benefit can be included in your taxable income calculation. Notice something important. That does not mean you're paying an 85% tax rate. It means up to 85% of your benefit can become subject to income tax. The amount depends on what's called your combined income, sometimes referred to as provisional income. For many retirees, this includes retirement account withdrawals, pension income, investment income, part of their Social Security benefits. Here's where things get interesting. The income thresholds used to determine Social Security taxation were established decades ago and have never been adjusted for inflation. As incomes and living costs have increased over time, more retirees have found themselves crossing those thresholds. A retiree doesn't need to be wealthy for this to happen. I've spoken with retirees who believed they had modest retirement income, only to discover that retirement account withdrawals pushed enough of their Social Security into the taxable category. The result? A higher tax bill than expected. And because retirement income often changes over time, this can become a recurring issue year after year. The second trap catches retirees by surprise because it involves money they've already saved. For decades, many Americans contribute to traditional IRAs and 401ks. The benefit is straightforward. You receive tax advantages while working, and the money grows tax-deferred. But eventually, the IRS requires distributions from most traditional retirement accounts. These are known as Required Minimum Distributions, or RMDs. For many retirees today, RMDs begin at age 73. And here's the key point. Whether you need the money or not, the distribution generally must occur. That means a retiree with a large traditional retirement account may suddenly find themselves reporting significantly more taxable income than expected. I remember speaking with a retired engineer who told me, "I thought my retirement account was simply sitting there growing for the future. Then I learned I had to start taking money out whether I needed it or not." That realization changes how many retirees view their savings. Because while the account belongs to you, the taxes associated with tax-deferred contributions have merely been postponed, not eliminated. And once RMDs begin, those postponed taxes start becoming current taxes. Failing to take an RMD can also result in penalties, making this a rule retirees cannot afford to ignore. Now we arrive at a trap many people never connect to taxes: Medicare premiums. Most retirees know Medicare is a major part of retirement planning. What many don't realize is that higher income can lead to higher Medicare costs. Certain Medicare premiums are based on income levels. If income rises above specific thresholds, additional surcharges may apply. These adjustments are commonly known as IRMAA, Income-Related Monthly Adjustment Amounts. Here's where the connection matters. What increases retirement income? RMDs, retirement account withdrawals, capital gains, other taxable income sources. In other words, the same income that increases taxes may also increase healthcare costs. I've seen retirees shocked when their Medicare premiums increased and they couldn't understand why. Then they discovered the increase was tied to income from 2 years earlier. That's right. Medicare often looks back 2 years when calculating certain premium adjustments. A one-time income event today may affect healthcare costs years later. That's why retirement tax planning and healthcare planning are often more connected than people realize. This next trap is one of the least understood. Many retirees believe they know their tax bracket. Maybe they think, I'm in the 12% bracket, so every additional dollar I withdraw costs me about 12 cents in tax. But retirement taxation doesn't always work that simply. In certain situations, additional withdrawals can trigger additional Social Security taxation. As a result, one extra dollar of retirement income may indirectly cause more income to become taxable. Financial planners sometimes refer to this as the Social Security tax torpedo. Here's a simplified example. Suppose a retiree takes additional money from a traditional IRA. That withdrawal increases taxable income, but it may also increase the portion of Social Security benefits subject to taxation. Now, the retiree isn't just paying taxes on the withdrawal itself, they're paying taxes on the additional taxable Social Security as well. The result can be an effective tax cost that's much higher than expected. This doesn't affect every retiree equally, but for those in certain income ranges, understanding this interaction can make a meaningful difference. The important lesson is simple. Don't focus only on tax brackets. Focus on how withdrawals affect your entire retirement income picture. And surprisingly, it isn't really a tax. It's a missed opportunity. Many retirees experience a period between retirement and the beginning of RMDs where their taxable income may be lower than it will be later. These years can create unique planning opportunities. Yet many people never realize the opportunity exists. They retire, they leave everything unchanged, and they simply wait. Then, RMDs begin. Taxable income rises, more Social Security may become taxable, Medicare costs may increase, and the flexibility they once had is reduced. I've seen retirees look back and say, if someone had explained this to me 5 years earlier, I would have made different decisions. The challenge is that this planning window doesn't announce itself. No letter arrives in the mail saying, attention, this is your optimal tax planning period. The years simply pass, and once they're gone, they're gone. That's why understanding this phase of retirement can be so valuable. Now for the good news. These retirement challenges are not necessarily unavoidable. In many cases, proactive planning can help reduce their impact. One strategy often discussed is the Roth conversion. The basic idea is straightforward. Some retirees choose to move money from traditional retirement accounts into Roth accounts during lower income years. That can potentially reduce future RMDs and create greater tax flexibility later. Whether this makes sense depends entirely on individual circumstances, but it's a conversation many retirees choose to have with qualified professionals. Another strategy involves qualified charitable distributions, commonly called QCDs. For retirees who already plan to support charities, QCDs can provide unique tax advantages while satisfying certain retirement account distribution requirements. A third strategy involves carefully managing where retirement income comes from. For example, traditional accounts, Roth accounts, taxable savings accounts. Each may have different tax implications. Thoughtful withdrawal planning can sometimes help retirees manage taxable income more efficiently. The key isn't finding one perfect strategy. The key is understanding your options before major retirement decisions become permanent. When you step back, these aren't really 5 separate issues. They're connected. Retirement account withdrawals affect taxable income. Taxable income can affect Social Security taxation. Those factors may affect Medicare costs, and all of them become easier to manage when planning happens early. The retirees who tend to navigate these challenges most successfully aren't necessarily the wealthiest. They're often the ones who learned the rules before those rules started affecting them. Knowledge creates options, and options create flexibility. Final thoughts. If you're in your 60s today, this may be one of the most important financial planning periods of your life. Not because something is wrong, but because decisions made during these years can influence taxes, healthcare costs, and retirement income for decades. Take time to understand your accounts. Understand your income sources. Understand how withdrawals may affect the bigger picture. And most importantly, Don't assume that doing nothing is always the safest choice. Sometimes the most expensive retirement decision is simply failing to plan. Now I want to hear from you. Before watching this video, did you know that retirement account withdrawals can affect Social Security taxation and Medicare costs? Let me know in the comments. And tell me this, are you currently in your 60s or have RMDs already started for you? If you found this video helpful, subscribe to Decoding Finance, hit the like button, and share this with someone approaching retirement. Because understanding these rules before they affect you can make all the difference. Thanks for watching, and I'll see you in the next video.